day friends. In the subject of personal financial planning, we are discussing lectures on, or I would say there is a lecture series on the tax planning, because tax planning is very important for financial planning. If you plan your tax liability properly, you can make your financial planning effectively. So in my previous lecture on tax planning, I was talking about tax slabs or tax rates which are applicable to different individuals on different level of income. And we also talked about different exemptions or certain exemptions which are not being included in your income for calculating tax liability. My focus here is basically on the individual tax SSC, that is individuals, if there are different type of SSCs, individuals, HUF, the companies, the corporates, limited liability partnership. So my focus in this lecture will be on the individuals. So let's continue with the exemptions that are allowed to the individuals. What do you mean by exemption is that up to a particular amount or certain income is not being included in your income. That is, you're exempted for calculation of the purpose of the tax liability. Like say HRA exemption. To start with, HRA exemption. House rent. HRA exemption means house rent allowance. See, house rent allowance is offered to employees to meet the cost of rented house that is taken by them. Friends, you should be very clear, if you are living in your own house, your HRA will not be exempted. It is only for those individual employees who are living in a rented house this exemption is available. Income Tax Act allowed the deduction in respect of HRA that is actually paid. That is that portion of the HRA that is actually being paid by the employee as rent. That will be exempted. So exemption is covered under section 1013A of the Income Tax Act and rule 2A of the income tax rules. So it means under this act your HRA is being exempted, and there is a particular way of calculating to what extent this HRA is exempted. I will be coming to that. However, you need to know that the entire house rent allowance is not deductible. Suppose the employee is getting 1 lakh rupees as a HRA, not necessarily that the whole of the 1 lakh rupees will be allowed as an exemption. There is a particular method by which you can calculate that how much will be allowed as an exemption. The employee must pay rent, means number one condition, you must pay rent, and the rented premises cannot be owned by the individual. Right? If he or she is staying in his own house, then HRA is not deductible and the entire amount is subject to tax. Whatever a HRA individual is getting, the whole amount will be taxed, providedly the individual is living in the own house. Or put it this way, if the individual is not paying rent, then the HRA will be not exempted but it will be taxed. How do you calculate what is the exemption? So there are three things. The actual HRA that is being paid to the employee, means all these three, the minimum of three, that minimum of these three will be exempted. So actual HRA that is being paid to the employee. Number two, actual rent paid minus 10% of your basic salary. Right? So if I am paying 50,000 rupees and my basic salary is say 2 lakh rupees, so the actual rent paid is 30,000 rupees actual extra rent that is being paid from my salary, from 10% of my basic salary. I am saying whatever my basic salary is, whatever the 10% of that comes, and the difference between the actual rent paid and 10% of the basic salary, that will use the calculation. Number three, 50% of the basic salary if you are living in a metro city like Delhi, Mumbai, Chennai, right? Or 40% of your basic salary if you are living in any other city. So out of these three, means there are three ways. The minimum of these three means out of whichever is minimum, that will be exempted from your HRA. That will not be included in your income. The other exemption is, one is HRA, house rent allowance. The other is leave travel exemption, leave travel allowance. Leave travel allowance is paid by the employer for employees and his family's travel and is tax free under section 10(5) of the Income Tax Act. 1961. The exemption can be claimed when employer provides LTA to the employee for leave to any destination in India, then the actual leave cost incurred are exempted. Suppose my employer I want to go to the, say, Trivandrum, right? And from Delhi to Trivandrum, the actual rent, that is actual fare that is being paid by me, and if my employer paid me that actual fare of, say, whatever my entitlement as per my entitlement, if I am traveling through rail or if I am traveling through air, whatever my entitlement means, at each salary level there are different entitlement. Means suppose an employee who is in the higher salary bracket, higher salaries, the person is entitled in the air through travel through air. Certain employees who are not allowed through travel through air, they have to go through train, right? So as per the entitlement, the leave travel allowance is being given. So when an employer provides LTA to the employees for the leave to any destination in India, then the actual travel cost incurred are exempt. So if you are going outside India, so then this is not being exempted from the income tax point of view. When the travel is within India and not overseas, the exemption is on the travel cost only and not the food and stay. This exemption, mind it, whatever is allowed to an individual, it is only for the travel cost, actual fare paid by the employee. So the family includes spouses, children, parents and siblings. Means your dependents are entitled for this rebate. Your dependent means whatever the LTA is being paid to the employer self and the spouse of the employer, its dependent children, its parents and the siblings. So what is the exemption? Journey by air is through economy class only, economy fare of national carrier by the shortest route or the actual expenditure, whichever is less, right? So when I am using the word national carrier, means there is a proper rule through which you can travel, you can buy the ticket, right? So the carrier, suppose the government of India, even the Air India has been now been sold to the Tatas, so you can travel in any of the company's flights, but it is exempt. It is exempt. But there are rules of the exemption. That is the actual fare, and the journey must be within India. The other is if the journey by rail, so AC first class ticket fare by shortest route or the amount actually spent, whichever is less. Place of origin and destination place of journey connected by rail, but opted if you are opting another mode of transport, then AC first class ticket fare by shortest route or amount actually spent, whichever is less, that will be entitled. Place of origin and destination place of journey not connected by rail but by other recognized public transport, then the first class or deluxe fare by shortest route or the actual spent, whichever is less. Means there are certain areas which are not connected by train. Suppose you are entitled only for train. So if you are traveling through some other recognized transport or public transport, then whatever your actual expenditure is, that or first class or deluxe fare by shortest route, that will be allowed. So place of origin and destination place of journey not connected by rail or by any other recognized public transport, then what you are entitled? AC first class ticket fare by shortest route, assuming that the journey was performed by rail, or amount actually spent, whichever is less. Means either the actual amount paid or the journey performed by train, right? So whatever the fare by train is, that amount will be calculated, and the actual amount you have paid, whichever is lower out of the two, that will be paid to the employee, and that is exempted from tax. Apart from this LTA and HRA, there are certain capital gain exemptions. Capital gain exemption, what is the capital gain? Just to tell you, like say for example, if you are dealing, if you buy and sell, if you hold some assets, like for example shares, right, and you dispose it off after 1 year, that is called, and whatever the profit that you generate, that you make by selling those shares after holding it for 1 year, that is called long-term capital gain. If you are selling the shares and your holding period means the time for which you keep these shares with yourself is less than 1 year, it will be considered as short-term capital gain. The rate of tax for the short-term capital gain is different than that of the long-term capital gain. So, under Section 54 of the Income Tax Act in India, exemptions can be claimed by an individual and Hindu undivided family. The residential house property that was held for 3 years has to be sold. Suppose you are living in a house and that you kept this house, you hold this house for more than 3 years or more, right? And you want to dispose it off. So you can buy a new asset and whatever the capital gain, suppose I bought this house say for 1 crore rupees. After living in that house or after holding that house for 3 years and more, I want to dispose it off. And if suppose the disposal price is 1 crore 50 lakh rupees. So 50 lakh rupees is my capital gain. Whether this 50 lakh rupees, the whole of the 50 lakh rupees, which is my profit, on what amount the tax will be calculated, this is the question, right? Or is this 50 lakh rupees, the whole of the 50 lakh rupees will be included in my income, or can I get some exemptions by using the proper tax planning and the financial planning? So what you can do is, if you want to minimize your tax liability, you can buy a new asset 1 year back, means before disposing of within that year, within that means before 1 year of the disposing of, you have bought an asset. Means supposing I am living in Delhi, I am disposing of this house and I want to shift after my retirement to say, for example, Kolkata, right? So Kolkata, I am buying a house before disposing it off, right? So within that year in which I have purchased the house and I have disposed of my house in Delhi, the entitlement of exemption is allowed. So you can buy a new asset 1 year back or 2 years from the date of sale. Suppose you sell in the current year, that is in December 2022, you are selling it. So up to a particular date of December of 2024, you buy a new house, right? So then you are exempted under this capital gain. Or if you are getting a new house constructed, you must get your new house constructed within 3 years of the sale of your old house. So this amount is exempted, is the investment. What you do, whatever the amount you have disposed of, you get by disposal of selling. So this amount exempted is the investment in the new asset or capital gain, whichever is less. Suppose my capital gain is 50 lakh rupees. The house I purchased was 1 crore rupees and I sold this house for 1 crore 50 lakh rupees. So what is my capital gain? 50 lakh rupees. Out of this 50 lakh rupees, I have purchased a new house in a village for 40 lakh rupees. So only 40 lakh rupees will be exempted, not the whole of the 50 lakh rupees will be exempted. Suppose I have bought new house which cost me 60 lakh rupees. So in that case, the whole of the capital gain of 50 lakh rupees will be exempted from my income for the purpose of calculating tax. So whichever is less, the amount exempt is the investment in the new asset or capital gain, whichever is less. Capital gain deposit account scheme is applicable. See, when you sell the asset, you sell your house, right? I mean, the amount should be kept or should be set aside in a particular account that is called deposit account, the capital gain deposit account scheme. This section 54B says exemption can be claimed by an individual and an Hindu divided family. The eligibility assets can be sold is the agriculture land that the SSC has used for agriculture purpose 2 years prior to the sale. That you must have used this land at least 2 years, right? Then only this income is exempted under section 54B. You can buy a new agriculture land in 2 years from the sale. This is the condition. And apart from this, the amount exempt is the investment in the agriculture land or capital gain, whichever is less. Means the either amount invested or the capital gain, whichever is less, that will be exempted from tax. So capital gain deposit account scheme will be applicable here also, like in the house property case. There is another section called section 54 54 EC. Any person can claim exemption under this section. The assets that can be sold are the long-term capital assets that have been held for a period of 3 years or more. You can acquire bond of National Highway Authority NHAI or REC Rural Electrification Corporation, and you get 6 months to acquire the new assets. The exemption amount is the investment in the new assets or capital gain, right? So whichever is lower. Subject to a maximum of rupees 50 lakh in a financial year. Capital gain deposit account scheme is not applicable in this case. Means you have to invest in the REC or National Highway Authority of India, right? Then only if you buy these bonds, then only the exemption is allowed. There is another section called Section 54F. Exemption can be claimed by an individual and a Hindu undivided family. The asset that can be sold is a long-term capital assets other than the residential property, provided that on the date of transfer, the taxpayer does not own more than one property, right? You are not using it for your residential purpose and disposing of, provided if it is you are not having in your name, you are not having more than one property, then you are entitled for exemption. You can acquire a new residential house property before a year from the date of sale or 2 years from the sale, or after 3 years if it is being constructed. Means in case of construction, the period is 3 years. The exemption amount is the investment in the new asset divided by net sale consideration multiplied by the capital gain, right? So capital gain deposit account scheme is applicable in this case. Capital gain account scheme means you have to set aside, you have to deposit this amount under the particular heads with the Government of India. Means only if you deposit this in that, then only this scheme is allowed. This exemption is allowed. Apart from these deductions, there are very important deductions that an individual can always claim, which is called tax deduction under Section 80C. Most of the salaried employees, especially employees with a reasonably higher income bracket, they always wants to get the tax deduction under Section 80C. Providedly, you have to invest under certain categories of investment, right, which the Government of India allows, or which I will say the Income Tax Act allows. Section 80C of the Income Tax Acts provide provisions for deduction on a number of payments with both individual and Hindu undivided families. Families eligible for these deductions, eligible taxpayers can claim deduction to the tune of rupees 1.5 lakh rupees. That is, under Section 80C, the maximum tax deduction that is allowed is 1.5 lakh rupees. So friends, when I am talking of the tax deduction, it means for the purpose of calculating the taxable liability from your total income, 1.5 lakh rupees will be deducted, and after that your tax liability will be calculated. Providedly, you have invested up to 1.5 lakh rupees under certain heads, under certain type of investments. Say, for just to give you an example, supposing in a particular year a salaried employee has deposited 1.5 lakh rupees in his or her provident fund account, right? Whether in the NPS under the old scheme, the public provident fund, or the PF, right, normally known as provident fund account. So up to 1.5 lakh rupees if you have deposited, even if you have deposited 3 lakh rupees, your tax exemption at AC will be only 1.5 lakh rupees. So up to 1.5 lakh rupees, your income will be reduced by that amount and your tax liability will be calculated, providedly you have invested 1.5 lakh rupees in your provident fund account, right? So as per the Income Tax Act 80C, with the amount being a combination of deductions available under Section 80C, 80CCC means CCC, and under Section 80CCD. Some of the popular means where you can invest up to 1.5 lakh rupees. These are the popular investments which normally the individuals do make. Some of the popular investments which are eligible for the tax deductions are mentioned here. Payment made towards the life insurance policies of self, of your children, of your spouse, or of your dependent parents, right? So payment made towards the life insurance policy that is deducted from that is eligible for deduction under Section 80C. I mean, maximum amount I have already told you that it is 1.5 lakh rupees. Payment made towards a superannuation provident fund, right? So if you have got some money for superannuation or under your provident fund, right, then it is allowed. Tuition fee paid to educate a maximum of 2 children, right? So maximum 2 children, the tuition fee whatever you receive, that is exempted from this. Payment made towards construction or purchase of a residential property, right? So the construction or purchase of a residential property, if you have made payment, right, that is also eligible under Section 80C. Payment issued toward a fixed deposit with a minimum tenure of 5 years. See, normally if you make a deposit with the bank, fixed deposit of 1 year, 2 year, it will not be considered for the purpose of calculating deductions under Section 80C. But bank FDs for more than 5 years are eligible to be considered under Section 80C, right? So if you make from tax point of view, if you are making the fixed deposit with a bank, you should go for the 5 years fixed deposit or more. This section provides for a number of additional deductions like investment in mutual funds, senior citizen saving schemes, purchase of NABARD bonds, etc. There is another section called Section 80CCC. Under Section 80CCC of the Income Tax Act, it provides scope for tax deduction on investment in pension funds, right? So means if you're investing in a pension fund, like say for example under NPS, National Pension Scheme, right, up to 50,000 rupees you invest apart from this 1.5 lakh rupees exemption which you are allowed under Section 80C, right? So if you're investing up to 50,000 rupees apart from this 1.5 lakh rupees, right, then your tax liability will get reduced, right, to the extent of 50,000 rupees. Means your taxable income, I would say rather. When I am using the word tax liability means from your total income, 50,000 rupees will be deducted for the purpose of calculating tax. So these pension funds could be from any insurer and a maximum deduction of 1.5 lakh can be claimed under it. Means 1.5 lakh rupees that you can claim under Section 80C, and then apart from this 80C, that 50,000 rupees additional tax deduction you can claim. Under Section 80CCD. Under Section 80CCD aims to encourage the habit of saving among the individuals, providing them incentive for investing in pension schemes which are notified by the central government. Contribution made by an individual and his employer both are eligible for tax deduction, subject to the deductions being less than 10% of the salary of the person. Only individual taxpayer are eligible for this type of deduction. There is another section called Section 80CCD1. Friends, there are various sections under which you can claim deduction. Once again, I am repeating that why these are important to know, because these are for proper financial planning. You must make proper tax planning, and for tax planning, it is important to know that how you can minimize your tax liability. So, make use of these tax provisions which I have just discussed with you. By using these tax provisions, you can reduce your taxable income, and then thereby you reduce your taxable liability. And once you are able to reduce your tax liability through legal means, then obviously you will have more money to spend, to save, to invest, and that is what better financial planning is all about. Thank you very much. We'll continue this tax planning in the next lecture.